Hi, Anu Buzruk, Senior Academic Assistant at the Learning Commons of College of DuPage. Today I'll be explaining a little bit about accrual system of accounting and the adjusting journal entries needed for the same. Now, how to take care of these adjusting journal entries so that you are sticking to the accrual basis of accounting. Let's divide these journal entries in 4 parts. The first 2 can be called deferral journal entries, or you can always call them something which is paid ahead of time. Then second part, something that is received ahead of time. Then the second half of that can be called accruals, the 2 parts being payable but not paid, and then receivable but not received. So these are the 4 categories of the adjusting journal entries. Let's learn them one by one. The most important part is whenever an adjustment is to be needed, think as to what originally the accountant must have recorded when that transaction took place. So let's take an example of prepaid rent. So suppose on December 1st of a particular year, the employer had paid rent for the facility where the business is happening. So since that rent was being paid ahead of time, it was the employer's asset, prepaid rent, and the employer debited $1,200 for 12 months rent, suppose, and he had paid it in cash. So cash will be credited with the same amount, $1,200. Now when the financial books are to be closed on December 31st, in order to stick to the accrual system, the accountant needs to reflect the fact that 1 month's period of rent has expired. The company has used the rented area for 1 year, 1 month, and that's why the asset value needs to be brought down, and rather the used up rent needs to be expensed out. So all you think is, what is that asset that initially I had debited? Prepaid rent. So now you will credit the same asset account and reduce its value from $1,200 to $1,100 by crediting $100. And then you will be expensing out the amount of rent. So you will debit the rent expense account with $100. So in this way, you are touching one of the income statement account, rent expense, and increasing your expenses, and you are touching one of the balance sheet accounts, prepaid rent, and you are reducing the value of your asset. Now let's take another example, which is a part of the second category, received ahead of time. So suppose again on the same day, December 1st, one of the customers had paid you ahead of time. So cash is debited, say $1,000. And the deal was that the project is to be completed in coming 2 months. That means the work is yet to be done, so it is an unearned revenue. You haven't yet given the services, so it is your liability to return the money till you give the services. So in this way, the accountant has recorded the fact that cash is received, but it is for something that is yet to be done, so it is a liability. Now on December 31st, you need to reflect the fact that out of the 2 months project, 1 month has expired, so half of the project is done. So since you have delivered half of the services, you need to reflect them in the accounts and you need to reduce your liability towards that customer. So look at the exact balance sheet item that you had used in the beginning. You will be using the same account, but this time you will be debiting that account unearned revenue. Liability will be debited, say $500, because half of the services are done. And then you will convert it into a service revenue. You earn the revenue by giving the services. So in this way, in the adjusting journal entry, again you can see you touched one balance sheet account, liability, and you touched one income statement account, revenue. Now let's go for the third category, payable but not paid. So again, let's see, suppose December 1st you paid the wages to your workers. Wages being your expenses, you debited the wages. Suppose you have paid $1,000. Again, suppose it is a cash transaction, so you will credit the cash. Now when December 31st comes, you realize, okay, December 31st, this time it is a Monday and I'm going to pay the workers on Friday. So this is the day when one of my workers has worked for me, whom I have paid the previous Friday, and now I'm be paying the upcoming Friday. So that means this December 31st Monday, he or she worked for me, so the money is due, payable, but I'm not going to pay because that is not the due date of payment. So I need to reflect the fact that the expenses which are related to the revenue that I earned have incurred. So I will be debiting the same expense account which I had debited before. Wages expense will be debited with further, say, $100 Monday wages. And here I'm not going to pay cash, but I'm going to show the fact that it is my liability to pay that worker. So you will be crediting the wages payable with $100. So once again, we touched one income statement account, wages expense, and we touched another balance sheet account, wages payable. Now the last one, receivable but not received. So whenever the customers take the services on credit or buy the goods on credit, they become your asset, accounts receivable. So you will be debiting the balance sheet item, accounts receivable, and you will be crediting the revenue because you delivered the services. So in this way, again, you will be touching one balance sheet account and one income statement account. So apart from going back to the original, what we need to remember is in the adjusting journal entry, you will never be using a cash account because all these adjustments are paper adjustments. There is no cash transaction happening. Either the cash transaction has happened before or the cash transaction is going to happen later in the next year. So these are the adjustments which are going to help us stick to the accrual basis of accounting and show the right picture of our net income and balance sheet position to the investors, as well as pay the right taxes to the government.